All right, good morning, everyone. Happy Thursday to you and yours. Hope everybody's doing well. Today is August 6th, Thursday, 2026, and this is our audio edition to Daily Trade Strategy. To satisfy the regulators, NFA Compliance Rule 2-29C subparagraph 1. I don't know who the regulators are, but you know who they are. Who the hell are they? Past performance not indicative of future results. Past trade with monies you can afford to lose. I like to call it not a loss. I like to call it a contribution to the effort. Kind of like a voluntary contribution. All right, look at the overnight action. Very Deadsville, to say the least. Just amazing how they can rip it up for 2 days and then absolutely crush the volatility. At least so far here in the overnight. All right, so not much to talk about really in terms of the overnight. It is cycle day 3. Again, we're above the cycle day 3 target here, right? 77.45, right? So you know what I'm going to call this type day, right? Wild card day. So wild card day on deck in terms of direction. We did get that pullback yesterday, just as a quick review from yesterday's activity, right? We had our line in the sand yesterday at 77.60. Today is 77.65. Essentially the same, plus or minus 5. All right, plus or minus 5. So pretty much right in that, right, kind of that box area there. All right, so a little bit of a bragging right. Again, we had an extension, all right, above the prior high yesterday. All right, D-level money box again was in play there. For those of you that worked on that. And then should be of no surprise. We get some sort of a pullback. And then once we get the pullback here, you know, it really is for the remainder of the afternoon, yesterday that is, right? It was an MATD type rhythm, right? And now that is rolling over also into, you know, today. So keep in mind that just because the day ends, it's not like flipping you know, you walk into your office, turn the light on, leave at the end of the day, shut the light off. Markets never sleep. They just continue going. And so this action here today or overnight is still very much, even though it's now a new cycle day 3, it is still very much an MATD. So everybody's kind of has gotten that, right? I mean, I know you know, everybody does want me to repeat, and which I will. And it's interesting. Uh, that's another topic that we could talk about at some point. The repetitiveness of you know, stating sometimes the obvious, but sometimes the obvious isn't so obvious, right? So that's a whole conversation. It's probably worthy for an entire workshop for that matter. But in any event, overnight here. So what's the potentialities here, you know, for today? Certainly anything and everything goes, but in terms of the daily trade strategy, we're 65s being line in the sand. So we have, here's one of the ways, again, I've offered many different ways to approach it, but one of the ways is, you know, you stick a line in the sand and you say, okay, what's the up, what's the down? But in order to find those levels, and again, we offer 3, but in order to find those levels, what I'm doing is just looking backwards. Okay, so I'm looking into, so to find out levels for today, right? I'm looking backwards. And that's really all I'm doing. It's not difficult, right? But the idea, and again, I don't want to, give out the magic sauce, but really, there is no magic sauce. Point is, what happened yesterday? All right, boom. All right. Now, what happened yesterday? What I was looking for was the day before. What were some of the kind of areas that offered some temporary pause? So today to be the kind of the same thing. So to the downside, okay, one of the things we can do simply is we still have to, since we're kind of on the lows from yesterday, so we still have to reference like 2 days ago, right? So basically 65s, what did I put down? Um, Very conservatively, 55s and 45s. So this was 65s up here. So 45s are right, pretty much kind of all this is doing is just getting us back into the lows of yesterday. And then, of course, 35s becomes below that, which is kind of in this area over here. And then at that point, if the market kind of moves down to this area, we'd be looking for some sort of reclaim, some sort of buy attempt. All right. But if it doesn't, then, we're going to then reference further levels from 2 days ago. To the upside, same kind of thing, right? 75. And again, I'm looking here, 85, 95. Okay, where did things change, right? This was the scene of the crime, right, on the way down. So if the market were to move back up there, it would look up towards the scene of the crime where it broke down from. Okay. So again, can you do this? Without a doubt, 100%, right? And I encourage everybody, I've always said this, but I encourage everybody to do that for yourself, because the idea there is to try to, plan out. It's not predictions, but trying to plan out. Like this would be called a fair value gap. All right. For you guys, the ICT guys, fair value gap. I never knew what a value gap was. Never heard the term. Most of those guys in ICT concepts, many of you are familiar with them. Order blocks, like what the hell's an order block? You know, how do you define an order block? I mean, just, but, people, here's another fair value gap. I mean, so which fair value gap is important? You know, go figure. But any event, um, same game plan, wild card day. If the market wants to go lower, I do still think the market, after a little bit of a breather. And by the way, pullbacks can happen not just in price. A lot of people, are looking for move up and then like this move down like this. Again, and then of course a move back up. But it can also happen move up, move down, and then, you know, consolidation or pullback in time, right? So pullbacks are not always price related. Most of the time they are, but a lot of times they're also time related. So let's have a good session, one step at a time. If you're looking for an initial long, that would be off the 810 level here at the 4075s. All right, let's have a good session, everyone. All right, let's see how this all shakes out. Yeah, we'll take a look at our first opening range levels here. All right. All right, so right out of the gate, a little bit more weakness entering in. Again, we'll see if the market can respond here, coming off the A10 area here. It'll be our first test down into the 40-ish area. All right, we could get the A10 long here. Let's see if it can pay. All right, A10 paid. All right, it stops coming to even on that. All right, so good start, A10. Again, that's the opening range low established now. Now what we'd be looking for, all right, again, if you're looking for shorts, again, that would be against the 89s, right, for the time being. But if the market moves above that, we'll have a low in place and we'll be looking for a bullish shift higher. Okay, so first play was to tag off the A10. All right, and get that, and that worked. All right, just manage it accordingly. Now we're looking for just a higher shift if we can get it. and then price would need to move above the 55.60. So everybody following with that? Kind of how the scenario, what we're looking for. Okay, so what actually happened? Price popped below, pushed below the prior low, right? And then we got to reclaim back above. Prior low, didn't go down to the D level, but prior low and a push back above. And that was right where the A10, right where the A10 was. Okay? So again, looking for that stuff in advance. You need to be thinking of that stuff in advance. Where's a key level? Prior low. All right, what would be a scenario? These are the questions you should be asking. And if you don't know these questions, you should be writing them down now, and then you'll be able to ask them in the future. Where's a key level? Prior low. What would be a play? Push below, reclaim back above. The reclaim is what? That's a long. Happens to be that the A10 is there as well. So is it the A10 or is it the reclaim of the prior low? Could be both in this case, right? Doesn't have to be one or the other. It could simply be both or just one. If the A10 was not there, it would be the same play. Push below the low, reclaim entry long. Okay, that's all you have to write out as a strategy, as a trade. Push below the low, reclaim entry long. Stop below the low. Does that make sense? Write that down. Write that statement down. Push below the low, reclaim back above, entry long, stop below the low. Stop below the pivot low. And now you'll have that forever and a day to work with going forward. That could be a play in your playbook. Doesn't have to go to the D level. Lots of times it will just pop above or below a level and reclaim it. Okay? Now take that same scenario, play, apply it to a moving average, an 89 moving average. All right, stopped out on the trailer. Okay, fine. Stopped out on the trailer. All good, right? So that would be the same thing if we're in an uptrend move, or in this case over here, use this as an example, right? The 89 price pops up above it and moves below it. Short sale, stop loss. Okay, that could be a play again in a more directional biased move, and it's essentially the same kind of play, reclaiming a specific level. So the level is just a dynamic EMA. Same play, slightly different kind of condition, right? Easy peasy. I mean, it sounds easy peasy, but the thing is, if you write it out, if you don't write it out, you're not going to remember it. If you write it out and have it, there on your sheet and say, okay, what are some of the plays that I'm looking for? And then if you encounter a scenario that you haven't outlined, such as like the one we're talking about, write that out. Say, you can label it however you want in terms of the title. What you want to do is you want to label it and say, okay, again, push below the low, reclaim, push above a high, reclaim, or reversal, whatever terms you want to use. Oh, I don't want to do that. I'll remember it. No, you won't. Guaranteed you won't. I'll place money on it that you won't. You just won't. But the more you encounter it, the more you see it, the more you work with it, the more you interact with it, you'll begin to remember it. Could take 100 times. All right, we're still within the opening range. Somewhat of a balanced profile at the moment. All right, so we'll be looking for if the market can clear and convert the opening high. All right, so again, that's going to be around the 60s. Clear, convert, stay above. All right, we can work. Price can work higher. All right, again, looking for, see if we can get a sustained move outside the open range. Cycle high. 5-minute high low, Freddie. All right, clearing the opening range. Again, you can see the 5-minute high is 57.50, low 40.25. Cycle high. All right, good. So now we cleared opening. All right, now we'll be looking for some sort of any pullbacks in. We want to be holding that, down into, say, to the 55s if it pulls back that deep. Okay, that's what we're looking for it to do. Looking for discounts now. Good. All right, right up to about the upper edge there, the developed value area. So this is another example. Again, I'm going to keep throwing examples to you. Okay, take the examples for what they're worth. But here's another example. Right, you have the levels here: high, low, midpoint of the opening range. Right, everybody's following. Okay, so you see price come down here below the midpoint of the opening range. You already know that the low held. Okay, what is the observation in terms of a lean? What's the lean? What's the orientation? Right, orientation is long. Right, how do you trade this? So again, we know the orientation, the observation orientation, the ODA loop. Decision action now. What's the decision action? If price goes below at a X level, in this case the midpoint opening, all right, and reclaims right here. Okay, everybody see that? X marks the spot with the circle. And reclaims, so that's a reclaim, right? What does that equate to? Buy. All right, so lean is up, you got to move up, you got to pull back below an identified level, and you can do the same thing for the EMA here as well. We'll talk about that in just a moment as well. But you have a 5-minute opening range, midpoint, clear, so dip below, reclaim above, buy. Okay, there, Steve 9 wrote it down. Super. Okay, let's use the EMAs. Dip below the EMA. Is the EMA negative or positive? It's neutral to positive, I would say, right? But still, the lean we know is up. So I'm going to defer to the long. Dips, but now let's just say so let's do this for a second. Let's really make it clear. Get rid of the opening range for a moment. Where's that? There we go. Let's get rid of the opening range for a moment. Let's just say the opening range is now not there. Same thing applies. What's the lean? Right? Long, right? What level can you identify? Well, what's our proxy? The 89 EMA. Okay? All right. Price below the 8. So price is less than the 89 EMA, right? So that's the setup. Okay, that's the initial setup, right? So when price gets back above the 89 EMA, right? Reclaim, okay, equals what? Buy. Where does your stop loss go? Right? Low pivot. Capiche? Price goes below the 89 EMA. Again, the lean is up. We get a dip in price. I can identify what that EMA is. Price reclaims the EMA. Okay? Back above it. You can see right in here, holds it right there. All right? That's a buy. Now, stop loss, max stop loss is to the pivot, but you may decide, if this starts moving higher quickly, then your stop loss could be tighter. Make sense? Capiche? All right. Again, shorthand. If price, right? So if price is less than the 89, right? That's the setup, right? When price or when or then, right? Price is greater than the 89. That's the reclaim, right? That's equivalent to buying. Stop loss goes below the low pivot, and then you take profits, you know, ahead of up in certain areas. This is kind of, to me, this is my shorthand way of writing down a scenario. If price, then when, right? So that's the OODA loop, the if then else. So that's a play. So this same play, although it's the 89, could be used for a high low, could be used for value high, value low, could be used for any level that you can identify. What you want to do first is, what is the lean? Long, short, neutral. Don't go try to chase price bars. In a tick chart, they move very fast, right? So we're not trying to chase after tick bars. I want to know what the price is doing above a reference level or below a reference level. Okay, so these are outlines. These are, this is, again, you can make it as specific as you want. I'm just doing a generic outline. You make it as specific as you want, but these are plays in your playbook. Okay, so hopefully you wrote those down, or you even have taken a snapshot. Keep it simple. All right, Steve Sabaj took a snapshot. Beautiful. Yes, right? Be a simple man, right? Love that song. Keep it simple. Does not have to be complicated. All right. All right, so let's just see how this unfolds here. That's going to probably be the core lesson here for today. If you're going to take away anything, there you go. There's Simple Man by Leonard Skinner. Yeah, I think that would be the core lesson for today. That's a good takeaway, something that you can use every single day. Then, of course, context is going to be important. Is it the first pullback, or is it a first test in a bouncing, things like that. I mean, context certainly is important. Not, you have to be, certainly selective, right? But just having that core understanding of, how would I trade this? You know, how would I trade a reclaim of a level, or look above? Kind of, again, we can categorize that reclaim as simply our dynamic PKV, right? peekaboo. It's really that is what really we're talking about, right? So we can talk about the reclaim like that as just a core generic peekaboo. Right? Peekaboo below the 89. The 89 is positive. Get back above. Okay, and then again, the whole core of it is you have a defined risk. You do it often enough. Are they all going to work? More likely not, certainly. But you're going to have a defined risk, and if it's a good backdrop context, you're probably going to get more winners than you will losers, or magnitude of the wins. It's not so much the percentage of wins; it's the magnitude. So it becomes a core play. And all you need is a what? All you need is a couple core plays. Find what resonates with you, define it, outline it, research it. Certainly, I'll never, say not research it. Research it. Go back and look for instances where the markets are bullish and it price pushes down below a level and reclaims it. Measure it. How far did that? What was the adverse excursion? Right. So again, I'm going to give you another example. Just take this simple area, for example. Let's just use this reclaim of the 89 in this particular instance, right? So your reference point is the 89. So you have a level of the 89, right? There's your level, whatever that level is. So price pushes below it. So the low here is what's referred to as the maximum adverse excursion. Okay? You choose a reclaim level. Let's just say, the level plus, 2. So you reference the level plus 2, meaning your entry 2 points above the entrance level, because you're not ever going to necessarily get the exact level you're referencing. So you got to give yourself a little bit of, okay, I'll buy it 2 points above. That's my reference price as entry. Could I get 2 points above a level or below a level? More likely, yes. So that's more realistic. So now that's your entry. Okay, that's your entry. Then for a maximum, again, that would be a reference entry. It's not actual a trade yet. Okay, it's not an actual trade yet. Keep that in mind. But you have a maximum of adverse excursion, the low from the reference. Okay. Then you look for where did the high occur before it started pulling back. So this becomes your maximum favorable excursion. Is everybody following what I'm doing? So you pick a reference. You're looking for a long. Your entry is going to be reclaim. So PKB style trade. You reference that low. That's going to be your reference maximum adverse. So how far did it go down against your reference level? Once you've entered, how far did it go up before it starts pulling back? So you have to define at some point, price is pulling back, and then you say, okay, that's my favorable excursion, right? So the initial move up, and then some sort of pullback. Once that pullback begins, your MFE, your maximum favorable excursion, is set in place, that high, right? So now what you do is you're measuring this, and you're measuring this when you're doing your research. So you're doing a spreadsheet. You're saying, I have an 89 EMA play, bullish 89 EMA plays. Let me look for instances. This is done your research. How far did it go below? Outline that MAE. There was a reclaim entry as a reference. Okay, how far did that go before it began pulling back? Maybe you give it a time distance, 5 minutes, right? You can do a lot of different things. You can do 5 minutes, you can do 3 minutes, you can whatever. You can design it how you want. Me, I'm just going to go, where did it start pulling back? Okay. Not, oh, it pulled back, I'm going to hold it, and it went up another 20 points. No, I want to know when the initial pullback. And that should be fairly clear, you know. So then you outline that. So now you build a database of that type of trade, what's your MAE and FAE, okay? And then once you have that data, you begin to build, geez, you know, for all the times that I've outlined. Now, again, you may just decide it's a first pullback play or first pullback to the 89. Again, you maybe want to specify that, right? First, not every pullback to the 89, the first. Because if you keep it where the conditions are the same, then you can compare apples to apples. If you start comparing the first to every reclaim of the 89, okay, then you're comparing apples to oranges. Although it's the same category, it's not the same trade. Does that even make sense further? See how I'm drilling it down? So now you can specifically identify that trade. This is how you start doing this stuff, right? And you start building that playbook, right? I can only give you the suggestion. This is a way of establishing some sort of metrics, some initial metrics. Not all the metrics. I mean, again, there's a lot more that goes beyond that. But these are some of the core metrics. You want to find out, does this trade have any efficacy whatsoever? Steve Nine loves that word, efficacy. Does it have any efficacy whatsoever? Well, this is, to me, this is the first and foremost way I'm going to try to see if there's some efficacy, you know? And then you start building that database. And then maybe you build a database where you actually truly uncover I want to see efficacy. Maybe that's next month's password, efficacy. Right, so that's kind of, you know, a way to do it. And of course, obviously, staying in alignment is always important. But I'm trying to, you know, kind of, because a lot of times prices will, you know, dip below a level and the level doesn't break, right? Remember, these are the average prices. That's just, to me, the average price is probably one of the most important, that is price of all the prices. It's the average price. The price itself, the bar, right? The price bar, that's going to move up and down like a jumping bean, right? It's going to go all over the place. But what's the what is that price doing? The price bar itself relative to the average bar or the average price. What is the average price doing? The average price is bullish, bearish, sloping up, sloping down. All right, so the average of all of that is bullish. So now, simply said, I want to buy near the average, which is fair value, right? Equals, let's just call it the average, right? Discount, right, is less than the average. And of course, premium, right, is greater than the average. Okay, that even makes sense to you further? So am I buying fair value zone area, a discounted area, or a premium area? If the trend is up or directional lean is up, then I'm looking for what? Fair value or discount. If the trend is directional lean is down, I'm looking for what? Premium, average, or fair value. So fair value is fine. I'm actually looking for premium in a direction. Simply said, that's all I'm looking for. Okay. And again, by thinking and viewing it this way, you're basically staying in alignment with whatever the average prices are doing as the day unfolds. So what's the average prices doing right now? Right? What's the lean? The lean is up. Where do I want to buy? Fair value, right? Or discount the fair value. I don't really want to buy well above fair value because then that becomes premium. And again, if you're kind of in this, unless it's a true breakout, where even if it does break out, I still want to buy the pullback to a breakout, right? These type of core rules that I've had for, quite some time, since the beginning of time. I'm not trying to like, got to get this price or I got to get that price. Because if I'm staying in alignment with the average price and the average prices are moving higher, and how do we know that the average prices are moving higher? So if we use the 89 as our average price proxy, well, we got 34 is above, right? And of course, I don't have the 13 there, but the 13 is rising there as well. So if I'm using 89 as my baseline EMA for direction, if the 34 and 13 are above it, well, where's price more likely headed? Higher. On average, it's higher. So I'm looking to do what? I'm looking to buy. Write down those core ideas or concepts or rules, guidelines. I don't like to call them rules. I like to call them guidelines. But the point is, follow those. I cannot even imagine how, if you don't follow those, or if you do follow them, you're going to get in trouble. I'm not saying every trade you take is going to be a winner, but you're going to be on that side, okay, you're going to be on the correct side of that directional momentum and structure, okay? Remember, I've taught you, I've been saying to you guys, I'm not trying to teach you how to trade, right? Because you know how to trade. I'm teaching you some of the, I don't know, call them hacks, call them mental hacks, thought process, really is kind of the thought process. It can be very stimulating by thinking that way. And yes, you don't have to take every trade. You don't have to be in there every single time, right? But if you develop the thought process like this, and again, this is just my approach. Are there other approaches? Without a doubt. This is just my approach. Do I have to hit a home run on every single trade? Nope. Can I make a couple $100 on a trade here and there? Yep. Adds up. Maybe at some point you'll get that aha moment, right? Some of you already have. Like, whoa, what happened? It's a great feeling when you get that aha moment too. And here's the thing also, because we don't know what price is going to do. Let's just say take this area right now. We're pretty much right in the fair value zone, right? Okay, so is that fair value? Yes. Could we buy it there? Well, that's part of our rules or guideline. Fair value is an area that we can consider a trade. Is it an automatic mechanical trade? I'm not talking automatic mechanicals. I'm just saying it's a condition where we can consider that. Okay. And again, context is going to be, is it the first push into the fair value zone, or is it the second or third or fourth push into a fair value zone, right? Again, context is going to be, somewhat important. All right. Maybe after it's been in fair value zone for a period of time and it re-enters value zone, fair value zone, right? Again, right? Or maybe this time you decide, you know what, I don't want to enter fair value. I'm going to look for a discount to fair value. And then if it reclaims above fair value, then I'll buy it. Still using the same process. All right. So the price now is moving above that 89. So don't say to yourself, if you were thinking, well, I'm going to try to buy them if it dips below and reclaims, maybe that's your plan right there, right? But then it holds and then moves higher. Do not say to yourself, oh shit, I should have bought them. See, look what happened. Do not say that. You're gonna create your own trap. You're gonna create your own trap. Okay? Market's not gonna create it, you're creating it. You could say, okay, wow, look at that. It held the fair value zone. Okay, what does that do for me? Not that I missed a trade because I was planning something a little bit different, but rather, wow, that fair value zone still damn holds, right? Boy, there's some efficacy about that fair value zone. Holy shit. There's something to that, right? So always try to frame it in a positive way that it can reinforce, right, the various concepts that you're using. And you say, oh, okay, I didn't get that one. Well, I was planning something different. Now, on the flip side, if you were planning, say, you know what, I'm going to buy that 89 EMA, and then it dips down here, right? And you have your stop loss and you get stopped out. You didn't do anything wrong. That one didn't play. Or you could say, hey, if it holds 89, so there's another way of doing this, right? If it holds 89 and then takes out, X bar high, right? So the right side pivot rule, I'm going to enter there and the stop loss will be below that low pivot at the 89. You see what I'm saying? It's the same process. Slightly, the scenario is modified, but it's the same process. You're not doing anything different. Market is just showing you what it's showing you. You decide how you want to interact with the market. And then whatever the decision you make in order to interact with the market, you have to live with your decision. In other words, how am I going to manage that decision? You may have metrics already to say, wow, again, there's a good percentage of the time that the market is, continues to hold well in that area. Okay, well, remember, we're playing the odds. We're not playing guarantees. We're playing probabilities, not assurances. Okay? Allow yourself, it's not a matter of being wrong. You're never wrong if you do this. I'm going to tell you right now, you are never wrong if you follow your trade plan. Never. Okay? So you can actually claim, I'm right all the time. I'm right all the time. You want to be right? You know how they say, right? What's the saying? Whatever it is about being right, everybody wants to be right. Well, I can be right all the time. Why? Because I followed my trade plan. But being right and making money is not the same thing. Having a winning trade. It just means I'm right on how I approached the trade or the strategy. You want to be right every time? Create a strategy, create a setup, whatever that is, and execute it and do the research on it so you have some metrics. And when you're satisfied with that, take the trade every single time. Same conditions every single time, without fail. I mean, to the best of your ability, right? Sometimes we do missed trades, whatever, but you know what I'm talking about. Best of your ability, take as many as you possibly can. And you'll never be wrong. You'll always be right. That's my story, and I'm sticking with it. Right? That makes sense to everybody? Is that empowering or disempowering? And what you'll find is you can uncover so many types of trades, right? Don't ever feel as, oh man, I should have bought them down there, right? See, it held. It should have bought them down there. No, if you were to buy them down there, the reason why you didn't buy them down there, enter the trade, is because you didn't have the plan to do it. You didn't have just didn't have it. Now you have some baseline ways of, what type of trades, you know, to be looking for. But you got to implement them. You know, just talking about them is part of the, process, but you got to implement them. You got to, and like for instance, if this, like right now, so price is, above the 34, right? So you can just say, all right, it's still positive, but that's not my entry zone any longer. That's just not an entry zone. It could be in a strong move, but maybe today it's the move isn't as strong, so it's not really my entry zone, right? Am I at a discount? No, I'm kind of at a fair value area even on CCI, right? Kind of a neutral area for CCI, right? Roughly at the zero line, somewhat neutral, right? So it's not my favorite. It's not a higher quality entry zone. Could eventually, work up and hold it, but again, at that moment in time, it's not. I'm going to look for something a little bit more discounty-ish. So again, all these decisions are constantly. You remember that, the OTA loop, right? It's like a Ferris wheel or a bicycle wheel, right? That OTA loop is just constantly moving, right? Decisions after decisions after decisions. It's just constantly moving. And if you miss something, BFD. You know why? Because the river of opportunities is never ending. And so now you don't have to feel negative anymore about yourself or about what's happening about your trading. Don't feel negative about it. So I missed that. Oh, don't feel, no. At least I'm not in the wrong trade, but I know what to do to find the higher quality trades, right? And not that you knew that it was going to unfold in a certain way, so now take a look at this. Now we're getting discount to the EMA, but now the EMAs are starting to flatten out a little bit. And of course, we kind of have this neutral, again, context is still going to be important as well. It is a factor. So you just say, well, I'm not really that, excited to start buying above, value high, right? Value. I'm not really, I'd rather like, remember, what's the concept of above value? You get 60, 70, basically 70% of all the activity is trading within that area. Well, if I'm starting to buy outside of value, all right, again, this is another concept. If I'm trying to buy outside of value, all right, I'm actually paying above fair value. And again, fair value in this case that I'm speaking of is the profile fair value. Okay, so I'm trying to, if I'm buying up here, right, just above that 34, if I'm buying up here, I'm really saying I'm really confident that that market's going to rip. But if 70% of all the trades are occurring in here, all right, then I'm looking at 30 or to 15% of trades above that, right? So I'm trying to buy in the highest part of a distribution where there's the least amount of activity. How's that? How's that phrasing it? I'm entering along in an area of the distribution where there's the least amount of participation. Uh-oh, right? Don't think that's too good. Have you ever thought of it that way? Right? Buying above fair in a normal distribution, so in a balanced distribution, right? If you're buying above fair value, you're buying in the 30%, or actually make that 15% because there's 15% down below, right? So you're buying in the 15% area of an entire distribution initiating along. How do you think that's going to work out for you? How do you think that's going to work out for you? In a normal distribution, in a balancing type distribution. Now, again, in a different distribution, we're going to talk, maybe something different, right? But in a balancing distribution. So the idea is, well, what type of distribution of price action are we getting? You can't see that in price. You can see it in the volume, how it's being distributed. So if I'm initiating along in the upper 15 percentile of the days or that area's distribution, I'm in the minority. I'm in the minority. And when you're in the minority, particularly in trading like this, when we're trying to trade a momentum move, right? Again, just ask yourself, how do you think it's going to work out for you? Bet you never thought of it that way. And I guarantee, figuratively speaking, mind you, I guarantee I would say 90-something% of the people, okay, wouldn't even have considered thinking about that way. The 10%, the 10% out there, right? And you know who they are. They're the best traders out there that they know. So again, when we talk about value high, value low distributions, things like that, it's nice, easy to say that, oh yeah, 70% of the volume, okay, that's great, right? We get all that, right? 70%, okay, well then that's 15 above here and that's 15 below there. Okay, that's great. That brings us to 100%. What does that mean? That's the thing. I can label it, but what does it mean? Nobody goes there. Oh, they label it 70%, 68.2%, right? So call it 70. But if you don't understand what that means, all right? In one way you understand it, but what does that mean for me in my trading? Never thought about it. Now you have some ideas to think about. Doesn't mean you don't buy. Here's the thing. Again, everything is kind of context related. Doesn't mean you don't buy if it's moving above the value high, but you need to see that the value high, that there's buyers are really pushing above that value high, all right? And then there's a volume starting to build above that, right? So there's really some buyers that really want to, maybe push away from this current value and expand value. Again, we need some evidence that they want to expand value. But if you don't have that evidence, you're in that 15% minority, you know what's going to more likely happen. And then I just say, good luck to you. I wish you the best. I would rather simply wait, let it unfold, than be the first down on the, in there because I think it's going to go higher. I may be right in that thinking, but let the evidence prove it. Why not let the evidence prove it? I'm throwing a lot at you today. I don't know why. I'm zoomed up on Robusto, zoomed up on coffee. I'm throwing a lot at you today. Ram says tomorrow, please drink the same concoction. Well, here's the thing: if you stick around with me long enough, you see these are, I guess some people call them gems, the gemstones, right? That that I end up spewing, But again, I don't have a lesson for this. I don't have a recorded lesson in it. Well, this will be recorded if you want to, it is being recorded on the stream. So if you want to review this, mark the day off, and you'll get it on the YouTube streams. But I mean, I don't have lesson plans for any of this stuff. A lot of this stuff kind of comes to mind in real time action, you know. And again, the market's the great educator. Look what happens here. So if we identify the value low now, okay, and yes, we can identify it. We understand how it's calculated. That's all well and good. But then what would be the expectation in that area? That is where the real lessons come. That's where the real insight to trading comes. What would be an expectation or an inference, not a guarantee, but an inference, an assumption? Do you have one? Action response in and around the value area when, remember, conditions apply, when it's in more of a balanced distribution. So we're at the lower edge of a 70 percentile price action. We know there's 15% down here. So if the majority of action is in there, right, what would be potential reaction when price reaches around to the lower edge of that. Again, not a guarantee, but what would be an assumption? What would be an assumptive interpretation? Buyers would probably step in, right? That would be an assumptive interpretation. Is it a guarantee that they're going to? Nope. But it is an assumptive interpretation of it. Potential that the buyers step in. So does that offer you, if for nothing more, it doesn't mean it's a trade for you. It just means that you're trying to interpret price action. And then when you see that it actually did that, you say, okay, well, I'm going to note that. Doesn't mean every single time it does that, it's going to, turn out that way. But the first touch has a high percentage of a reaction. Where have you heard that before? First touches. Okay. So you see, again, you're taking these concepts, and these are conceptual, right? This is not saying, okay, that's a trade I'm giving you. I'm not giving you that trade. It could develop into a trade for you, but I'm not giving you a trade there. It's not saying, okay, do this every single time it hits that level. I can't do that. I don't even do that for myself. What I'm trying to do is read the price action. And in order to read the price action, you need to have some sort of guide of interpretation of what price has done in past at certain areas under certain conditions. And we're looking for, you're using that as the model to what may happen here. Now, today's unique. Everything here is unique for today. Okay. Got that. But, so you don't try to keep guessing. You just, hey, I have an assumptive model. What is happening? So now here, again, I'm not in a trade because I'm explaining this. But the thing is, here's your initial reaction, value low. Okay. And then price bounces up to what? The midpoint. What would be an idea or a reaction if price pushes up to the midpoint? Well, we got an 89 EMA now. Okay. So what would be a trade here? Fair value zone, and then a pushback outside, below that, right? Just as we were talking about before on the long side. Yeah, you can use law of alternating pivots if you want, right? But you see the structure as it's moving around, as it's shifting. You need to shift along with it, right? Because it's dynamic, right? Yes, value low reaction, that's one. 2, 34 is below 89, moves back up to the midsection of the value zone. Okay, something is it's in the process of changing. What am I doing? Or is there, or you could be simply, when I say, what am I doing? I could be simply just watching. Or is there something that I want to be involved in here? Right? So, and again, this is all stuff that it's all constantly thinking about, what is happening. What are the reference areas that I need to, at this moment in time, I need to be aware of? I don't know what's going to happen, but what is happening? All right. So what tools do I have to work with that? Okay. If we got a shift unfolding, then I'm looking for some sort of a bounce that gets me in alignment with the 89. Right? Crazy concept, right? Am I looking for a 20, 30 handle move? No, I'm looking for 3, 5s, 8s. And then if it blows out to a big move, great. Crazy concepts, right? All right. Ram says, notice that after the first pullback, and if it comes back up, it takes the prior high by a point or so and fails, can be a good trade. Yes. I mean, again, there's so many different variations. And that's the thing. This what you'll find is, the longer you do this, the more just this nuances of all the various trades, happen, right? If you can get away from, here's really the crux of everything, I think. If you can, in your mind, all right, I know nobody wants to lose. I get it. I don't want to lose either, right? On all my trades, on any of my trades, right? But what happens is if you're focusing on that you don't want to lose, it's your body goes in protection mode, right? Your mind, it goes into protection mode, right? The old fight or flight, right? It goes into protection mode, and that's nothing wrong with that, right? It served humanity, human beings forever. But the problem is with trading, it's an enemy. It really is an enemy. Okay, and that's really where the battle lies. I can show you all the things to do here and what to do and how to execute them and everything else. Right? I get, keys to the kingdom, right? But if you still struggle internally, of taking a trade because of the uncertainty. So like prices move like right here. right? You got a little bit of bounce right above the 89. Now I could talk to ad nauseum about a look above it, come back down and execute a short all day long, and you're going to feel very much empowered, right? Holy moly, look at that! Oh, look at that! Oh, look at that! Right? And that's what happens when people go to seminars and things, right? You get really jazzed up, right? You get like, holy moly, look at that. But the problem is that, and it's all good. I'm not saying it's not. It's just that when you're now left to yourself, what happens? You fall into the same trap. I'm afraid. I'm afraid. What happens if this doesn't win? I want to be a winner. Okay. Instead of saying to yourself, I want to be a winner, say to yourself, I want to be a good loser. Right? In one of the ancient cultures, I don't know if it was Japanese, Chinese, one of those ancient cultures years back, they said it's a good day to die. Maybe it was Scottish. Anybody hear that before? It's a good day to die before they went into battle. It's a good day to die. All right. Nobody wants to die, but it's a good day to die. In other words, they're prepared to die and they do it anyways. Not that they're crazy. It's just that they've accepted, right, that death could be an outcome, a very real outcome. So they say to themselves, it's a good day to die. I'm going to go in and do my best. And if I do my best and I'm victorious, then I won't die. But it is if I do die, in my mind, it's a good day to die. And when they say that to each other, as an army, right, they all say it's a good day to die. And so they're all, you know, it's an accepting thing. So in trading, maybe you kind of think about things like similarly, right? It's a good day to lose. You don't want to lose. You're going to do everything you can not to. But if I do lose on a trade, right? It's a good day to lose. In other words, I did the right thing. I traded it correctly. I did everything in my ability not to lose. But if I do lose, it's a good day to lose. Boys, guys, I'm dropping some real diamonds on you guys today. You better, August 8th, 2026, you better go back and watch this recording. There's some good diamonds coming at you. Peter Brandt says I expect to lose in every trade I put on. Yeah, he's an old timer that's been around. I mean, I respect him. I spoke to him years ago. Very nice guy. Super nice. But the amount of experience he has, 50 years, yeah, bit more than me. Fastaphine says, she asks, could you please show how you decide on the stop loss? Well, so it's really not very difficult. One of the key things is, all right, let me just use this as, well, I'll use this as an example. So, uh, Fastaphine, you're familiar with what we talk about in terms of premiums and the direction. So premiums are sells, right? So these signals are sells because we're in a down direction. Okay, do you understand that? I mean, that's first and foremost. Okay, I know you do. I just wanted to acknowledge that you did. All right, so these are premium, what we call premiums. Okay, and that just means that the CCI has come up to this what we call premium level. Okay, so that's one of the core things. So now we're looking to take a short from these levels, right? So the direction is down, right? We're staying in alignment with the direction, and so we're looking to take shorts. Okay, so sells. Okay, so that's kind of the first start of it, right? So when price is in our premium condition, we're looking to short, right? Kind of when it hooks down, right? So we're looking to short when it hooks. So this is your pivot high, right? So up here, pivot high, pivot high, all right? So if we're taking a short here, what we call this is the right side pivot rule, right? Why? Because there's a pivot high and we're entering on the right-hand side of that pivot high in terms of a short. Same thing in terms of a long. So in terms of a long, it would be down here, it would be moving up, and we enter here, long, right, with a pivot down there. Okay, so structurally, that's what we're looking at. Okay, so you're following along with that as well. So in terms of placing a stop loss, all right, I'm looking at placing a stop loss at where, so what does, okay, so one of the things that we define a pivot high. So a pivot high is where it peaks, right? That peak price. Okay. So what we consider what happens at that point? That's where the last buyer on that move up, right? That's where the last buyer bought. Would you agree? Think about it that way. It's not where there's the most supply. It just is where the last buyer bought. No buyers above that price point. Would you agree? Okay. I know you're going to say yes, but just as long as you understand that. There's not that there's a lot of supply there. It's just where the final buyer bought. So and then before it started going lower. So if we wait for that point from where the last buyer bought, and then price is starting to hook back down, we want to then short. I'm not trying to short at the high. I'm trying to short coming off the high. That's number one. That's another piece of the puzzle. And the reason for that is because I recognize that there's no buyers above that level. Well, if there's no buyers above that level, I want to sell now. Plain and simple. I want to sell now. I don't know how far it's gonna go to the downside for me. I'm not uh I want to sell them because the last buyer bought. So where does the stop loss go is to your question. The stop loss goes to where above where the last buyer bought. Stop loss. How much? I don't put my stop one tick above, right? Maybe a couple points above, right? But the point is, right, wherever that pivot low or pivot high is, that's where a stop loss will go. Why is that? Why am I selecting those levels? Because that's where the last buyer bought on that rotation down or up, either one, right? That's where the last buyer bought. Okay. So, and my anticipation is the price is going to go lower so I can take profit. But if after my entry it doesn't go down and then goes right back up and goes above where the last buyer bought, well, what is that telling me now? Well, there are buyers willing to pay higher. Does that make sense to you? So because of there's buyers willing to pay higher than where the last buyer bought up there, I'm GTFO. You know what GTFO stands for? I'm GTFO. That's where my stop loss goes. Plain and simple. Okay? That's how I determine where my stop loss is going to go. It's going to be based upon where the last buyer bought or where the last seller sold. Okay? Everybody else understand that? Pastor Payne, you understand that? Now, if you're shorting, see, here's the thing. If you're shorting and the market's moving higher and you decide to sell short here, all right, let's just say you do that, right? You see the market's moving up and you think this level is going to stop and you're going to short them. Well, you don't have a pivot yet. You don't have a high yet where the last buyer bought. There's no evidence that the last buyer bought. The evidence is when it pivots back down. But if you don't have any pivot yet, the market is telling you the last buyer has not bought. Why are you shorting if the last buyer hasn't bought? Right? So again, kind of this idea is I want to enter where after the where the last buyer bought or where the last seller sold. To your question about where to place stop losses. Pretty cool, right? Have you ever thought of it that way? A lot of the key to all this is the market's going to do what it wants to do, right? We don't have control of what the market's going to do. What do we have control over? We have control over what we're going to do in response to what the market is showing us, offering us. That's what we can do now. Pretty darn cool. All right. Yeah, the idea of where the last buyer bought or the last seller sold. Okay, be honest with you. You know, not too many people really understand or even have been taught that way. I was taught that way, and you know who taught that to me? When I was at market making firms in my early career. That's who taught. That's where I learned it. You don't learn it from a book. You don't learn it. I've never heard anybody. I've never heard anybody, other educators in any way out there, have discussed it in that way. I learned it, many, 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 many years ago when I was learning to be a market maker and what it meant, various price action, and what the price action means. And so again, back then I learned concepts, right? So even before, like, there's two parts of, I think there's two main parts of trading. There's the mechanical, which everybody can learn very simply, right? The mechanical part of it. Actually, it's three parts, but there's the mechanical part of it. So number one, the mechanicals, the mechanics. Number two, the conceptual, the understanding of what's happening in the price action, which is different than mechanical. Okay. And then the third of it is the certainly probably the big kahuna is the psychological, or what I call the emotional. People call it trading psychology, and everybody's heard that term. I call it trading emotionology because really it's your emotions that are driving it. People call it psychology, but it's really emotions. Fear is an emotion, right? Excitement is an emotion. So to me, it's emotionology. It's not psychology, but it's categorized as psychology. So there's three parts: mechanical, conceptual, and the emotional. Steve Nine says, I'm getting tired of writing these diamonds down. Well, they'll be with you for many, many years, Steve-O. Hopefully they'll be helpful to you. Yeah. And I think, anyways, once you start looking at things in different kind of perspective and applying, it's like, wow, you know. So another thing, like here, here's another idea. I mean, I'm just throwing it. These are all the ideas here. There's not a new idea that I'm going to talk about here, but it's the same. So where's the reference level here, right? The prior low, that yellow line. What price comes down to that area? What the question is, what do you anticipate? What's your expectation? Okay, what's your expectation? Well, what do you think could happen? All right, so let's kind of walk through it that way. Let me just stop the shaking here. What do you think could happen? All right, so again, so everything is scenario. The way I think about everything is scenario based, right? So I see that there's a prior low there. Everybody in the world sees it. So what are some of the potentialities or scenarios that could happen there? Price could come down near it and then move away, which in that case it did, not by much, but it did. That's one scenario, right? So scenario one, right, near, let's call it near, and then pivot, right? Scenario two, okay, would be touch and then reverse. A scenario three, which didn't occur, right, could be dip below, right, and reclaim. We just do RC for reclaim. In all cases, what's generated here? A pivot. Okay. So in this, all these scenarios are referenced around the prior low. So do you know that the market's going to go through that prior low? Does anybody in the world? No? No, you're on the equal playing field as everybody else. Exact equal playing field as everybody else. The difference is how you are thinking about it versus how somebody else is thinking about it. So we lay out, I have a 3 scenario outline here. They all could be valid, but I don't know which one's going to play out. So which one do I play, or how do I play it? I'm going to play it the same way every single time. What's the play? Price moves down. It starts pivoting back up. I'm going to do right side pivot rule. And my stop loss goes below whatever the pivot low is. Same play, 3 different scenarios. So do you know which one's going to play out? Know which one's going to work? Nope. But how do I know that the first one, where I can see that it went near it, didn't touch? Does that matter? No. What I'm going to do, I'm going to be buying them on the right side pivot rule. What happens when it touches? Am I trying to buy the low, the prior low, at that level? In my scenario, I'm not trying to do that. What am I doing? I see that it did. It starts moving back up. I'm going to buy the right side pivot rule. Where's my stop go? Below that low. How many contracts and what am I willing to risk? I can figure that one out. Okay. Third one, which obviously didn't occur, goes below, dips, reclaims. Where am I buying it? Well, maybe in this case, I'm actually buying it on the prior low. Again, there's some variation there. I'm just using this as a model now. I'm not putting prices on it, just a model. Okay. So it dips down, reclaims my entry. I'm doing what? Right side pivot rule. I'm doing the exact same thing in 3 different scenarios. In all 3 scenarios, I don't need in any way, shape, or form. I don't need any shape or form to know what's going to happen. So what? Okay, so what's the? So Freddie asks, which is a good question, right? What happens if there's no reclaim? Well, what happens if there's no reclaim? I'm not buying them. I'm not entering long. So I have a plan for if it does not reclaim. Okay. The thing about using right side pivot rule, and I stress this a lot, you don't have to use it. This is just a technique that I've used for years, and it's just, to me, it works. Right? If you want to buy a level, enter at a level, I have no issues if that's what your plan is. But I'm talking, most people are not going to be able to handle that. Just buying a level, selling a level. Most are not. So I talk to the most, not to the, I talk to the majority, not to the minority. But the minority is fine if they want to do it that way. But if it doesn't reclaim, right? But if you're using right side pivot rule and it doesn't reclaim, well, what's the reason to buy it then? If it bounces a little bit and doesn't reclaim and then rolls over, why would you want to be buying it? Right? So when you're using right side pivot rule, keep in mind, right side pivot rule does not guarantee a positive trade every single time. What it will guarantee you is that you have a defined risk if the trade does not play out. You have a defined risk. That's all I care about. Whether it works or not, again, market's going to have to help us on that. But I I can select whether or not I want to and how I'm going to enter the trade. What's my decision to enter the trade? You have that power. Don't subjugate that power to the market by just buying it because you think it's going to hold. My view is, in my thinking, if I think that level is going to hold, 99.9% of the time it's not. And for that fraction of a percent that it does, again, it's like buying the top 15%, right, of a distribution. Like, why would I want to do that? I'm in the minority. You may feel good. Oh, I want to buy. I'm a counter trend trader. I want to buy that dip when nobody else wants to. Good luck. Right? It doesn't work for me, anyways. That's just my experience over the years. Take it for what it's worth. All right. Does this outline help, Freddie, for you? I know you're back with us. Although you've seen these things before, I mean, it's obviously very good review, I'm sure. Right. So again, 3 different scenarios, same level, different scenarios, same approach. That's the key. I'm doing is do the same friggin' thing every single time. I'm not doing this and doing that because the market's doing this. So I'm going to do something different. I'm going to do the same thing every single time. And yes, am I going to give up some location for the entry? That's the trade-off. But if you're in alignment with the primary direction at the time, and you're working to get in alignment with the primary momentum direction, then the trade-off is a very small trade-off. And the reason is it's going to, being in the direction is going to help you with that trade-off in terms of the location. I didn't get the perfect location, but I'm in alignment, so the alignment should help counterbalance the trade-off of not the most perfect entry, you know. So good question. So now, all right, so talking about a failure to reclaim, is that what you're asking about? The scenario of a failure to reclaim? Let's talk about that. That's a good yeah. Okay. So let's clear the screen here. All right. So this one's a failure to reclaim. All right. So let's use the same kind of scenario here. Use this prior low. Okay. So this is the scenario, all right? So price comes down below the low, makes an attempt to reclaim, fails to reclaim, so fails RC, all right, for reclaim. Where do you have, what's your references now? What are your references at this moment? Your references is the low, or that line that it's trying to reclaim. You also have a reference of what? A pivot, right? So take that pivot, draw a line. Now you just have drawn a new line, a new reference line. And the reference line is the pivot, low. So if it fails to reclaim and rolls over this way, what's your entry now? Entry is a violation of the pivot low. Where does you stop? Wherever it failed and pivoted. Now you have a new pivot here, right? You have a new pivot right here. So you have a new pivot right there. That's where your stop loss goes. Holy moly, right? And what are you doing here? You're just entering this as essentially, right side pivot rule, but now to the opposite side. right? Because if it fails to reclaim, what is that telling us? If it fails to reclaim, telling us in this case the sellers will probably are more dominant. So if the sellers are more likely to be dominant, remember we're making those inferences. If the sellers are more likely to be dominant, what are we going to do? I want to short that. Where does my stop go? However high they tried to reclaim it and they pivoted back down. That becomes the pivot point. And again, to Faster Fiend's question about where do you put your stop loss? Stop loss is going to go above the failure pivot to reclaim. Does that make sense? Now we have a scenario where it doesn't reclaim. What do you do? How do you handle it? There you go. Okay, does that help? Again, take a snapshot of this stuff. Write it, either write it out or draw it out on your charts or on a piece of paper. You know, take a pencil, pen, whatever, and draw it out. And this becomes a play, part of your playbook. All right, let me just show you another example. I'm into examples here. So let's go. Let's go this over here on the right-hand side for a moment. Okay. Let's look at this area right in here. Okay, what are we seeing? We see the move up, we move down, we move up. Okay, kind of chugs around a little bit here. So at this point, right in that area, okay, what levels can you identify? I'm going to show you, but think about it. I can identify this level, I can identify this level, right? There's your two pivots. Okay? So price bounces up, chugs around a little bit, and starts moving down this way. So what are your choices here? And again, bigger picture is beginning to weaken. So let's just kind of roll it off that the lean is to the sell side. What are your choices here? If you want to be involved, right? Shorter break of this pivot. Okay, so that would be in here. Shorter break of that pivot. Where's your stop loss go? Maximum stop loss will be above that pivot. Maximum. Could be less than that, but maximum. Why am I choosing that? Because as I showed Faster Fiend earlier, that's where the last buyer bought. All right. So this is what I have to work with. Everything else ahead of that, before that, is irrelevant. At this moment in time, at that time, this is what we had to work with. Price breaking down below the 89, 34 is rolling over right in there. There's your pivot. That's my reference. If it breaks that pivot, I want to short. How do you short? In this case, it's going to be either a stop loss order to enter, or a stop order to enter, rather. Not a stop loss, but a stop order enter, or you just smack the market. Hit the market button. So you have a couple choices at that moment in time. All right. You see what I mean about you need to see what's going on, what's happening, and then you need to plan, right? What if? What if? If you're not doing what ifs ahead of time, you're way behind the curve. You've already potentially lost if you're not doing what ifs. Because the what ifs is where you plan out the trade in advance. If this happens, I'm going to do X. If that happens, I'm going to do Y. If nothing happens, I'm going to do Z. Okay, so you have scenarios.